All right, we're going to dive right in. Not going to spend a lot of time standing on pomp and circumstance. We are live, and I wanted to take this opportunity just to kind of prime everybody that may join or see this video later. This is just a conversation that we're having about the new big, beautiful bill that was signed into law on July 4th. Um, as as it is with any major piece of legislation, there's always going to be initial commentary, initial things coming out about the legislation. But when you start talking about tax legislation specifically, it almost never fails that there are parts of the bill or parts of the overall tax package that require some generalizations because there could necessarily be, there may be some additional clarification that needs to come in from the IRS because our tax code is quite complex and it is confusing, and there are multiple different types of definitions that sometimes we need clarification on. But this is just reading through some of the initial provisions of the bill and wanting to talk about things that I think are going to be relevant for people that are everyday folks, planning for retirement, investing, people that are looking for good quality tax planning strategies. And so that's what I'm going to highlight today. So first and foremost, the big thing that did happen is right now there were no changes at all to how Social Security is going to be taxed. That was a big piece of Trump's campaign, where he wanted to, or at least he threw out there very specific language about how he wanted to make Social Security not taxable. There were no provisions in this bill that changed how Social Security would be taxed. Now, it is possible that with some of the things we'll discuss, that some people may actually see their overall tax burden reduced to zero, but it will not be because there were specific language as it related to Social Security benefits. I still maintain that we may, in fact, see a standalone piece of legislation for Social Security. I do know that there was a bill introduced in Congress. Whether or not it gets out of committee and to the floor for a vote will remain to be seen. But I think anything with Social Security is most likely going to have to be standalone. It's too complicated of a topic, too polarizing. I don't know that they could fold it into a giant bill like this and expect it to be passed. So that's what you need to know about Social Security. So let's dive right in. There was some language in here that I think is interesting because it relates to the ACA, the Affordable Care Act, and people who are purchasing those policies and receiving premium subsidies. So if you go back to the original passage of that bill, the ACA, there began with premium subsidies to help people afford these new plans, or the higher cost of these plans. They were adjusted based on income, of course, and so if you made a certain level of income, you were not going to receive any type of premium subsidy. Well, in 2021, I believe there was an enhanced premium subsidy, or there was a premium subsidy enhancement that took place, and then that was actually extended by the American Rescue Plan extended that premium tax subsidy, that made them more enhanced. So the big beautiful bill did not extend any of those premium tax credits. So starting in 2026, the ACA premium tax rules go back to where they were before 2021 when those credits started. So if you've been on the ACA and you've been receiving those enhanced premium subsidies and you still anticipate being on ACA plans next year, you definitely want to look at where you're falling with your income and whether or not that's going to impact you, because it does appear that those premium subsidies are going to go away, or be reduced back to the original rules that were in place before they were added. But the interesting part of this is that starting in 2026, there are going to be certain plans like the Bronze Plan or other plans that are on the ACA that would now qualify for as a high deductible plan, where you could now have an HSA. That's really interesting because HSAs tend to be probably, in my opinion, one of the most, if not the most, tax efficient way to save for the future. Because with HSA plans, you get to put money in, or money goes in pre tax. It grows tax deferred. And if you use it for qualified medical expenses, the withdrawals that come out of the HSA are actually tax free. So you have triple net tax, tax benefits there. There is no other plan or program that I know of that has that ability that an HSA has. So the fact that they are looking to give some of these folks that are on these ACA plans access or the ability to have an HSA is a pretty neat opportunity for some of those people that want to plan in that way. Okay, so let's talk specifically about the bill. So this during Trump's first term, his tax package was called the Tax Cuts and Jobs Act of 2017. It was passed into law, but the provisions for those rates were set to sunset, so meaning they were temporary. And this bill made those rates permanent. And I say that tongue in cheek because the tax code is written in pencil. So when I say permanent, all that means in my mind is that permanent meaning this Congress and this president are not planning to change it. We could see a complete turnaround the next time around we have an election cycle, and if there is a new president and a new Congress, they may want to make adjustments to the tax code, and if they have the votes to do it, they can do it. So the tax code is written in pencil. So remember that, even though it says it's permanent, and many of the people who are proponents of this bill are going to say, hey, it's permanent, the tax code is, in my view, written in pencil. Okay. So, but the current brackets that we have now were extended. So that's a really good thing, because there was a degree of uncertainty for a while. I personally felt like they were going to get something done, because nobody wants to go into a midterm election and not have done something significant to go back home and tell their constituents. So even though this bill was, passed on a very partisan basis, you're going to have both parties saying that they, one party says they fought for it, the other party says they fought against it, and they want to get people to vote. But so the current tax brackets that we have were extended and, quote, on a permanent basis, which I believe that gives all of us some added clarity for how we want to plan moving forward. Remember, the bottom four marginal brackets are 10%, 12%, 22%, and 24%. Historically, these marginal rates are historically low compared to other tax brackets from the past. So I think there's still a lot of planning opportunities for us to take advantage while we have these lower marginal rates. Let's see. The biggest thing that they continue to, I think, propose as a main feature of the bill is they're still saying they simplified it by giving everyone these larger standard deductions. And so they did make those standard deductions permanent, and they gave them a little bit of a bump for this year. So if you're a single file, the standard deduction for 2025 is going to be $15,750. We double that. So for married filing joint, it's going to be $31,500. Both of those are slightly more than what we were scheduled to receive in 2025. So that's a good thing. That's a little bit of a bump there. They also have the additional standard deduction if you are over age 65. So if you're over 65 and you're a single filer, you get an additional standard deduction of $2,000. And for married filing joint, for each spouse that is over 65, you get $1,600. So we're starting to get into some real money here. If you're married filing joint and you're over 65 years old, your standard deduction starts at $31,500 for this year. Plus you get an additional $1,600 per spouse. That's real money. And that's going to be beneficial. But wait, there is more. They just added a enhanced or an additional standard deduction, or I should say personal exemption, which is really interesting if you'll give me a moment here, because the original code we had before the Tax Cuts and Jobs Act, we had a standard deduction and we had personal exemptions, and then we had miscellaneous itemized deductions. And that was just too complicated. So they came in and they said, hey, we want to simplify the code. We're going to do away with personal exemptions, and we're just going to give everybody this enhanced standard deduction. And that's the code that we've been having, or that we've had for the last several years. Well, now we have this new code, or an extension of the current code, but now we not only have the standard deduction, but we're bringing back a personal exemption. Make it make sense. All right. But that's to say, we have this, it's very temporary from 2025 through 2028. There is an additional $6,000 personal exemption for people who are over age 65. So if you're over 65, we get a new additional personal exemption of $6,000. This is on top of whether you itemize or file a standard deduction. So I just said, if you are married filing joint this year and you're going to have the $31,500 plus the additional $1,600 per spouse, this is in addition to that. So we have some definite households that are going to fall in the income range where we want to reevaluate tax planning strategies in the back half of this year to take advantage of this. Okay. So this extra deduction, what's really interesting is they begin to have phase outs based on your modified adjusted gross income. But wait, it's not the technical definition of modified adjusted gross income, because there are multiple definitions. It's actually this interesting definition that is basically your AGI minus some foreign tax credits or taxable tax benefits. So for most people, the modified adjusted gross income in this instance is likely going to just be your AGI or your adjusted gross income. But definitely check with your tax professional and make sure you understand clearly exactly what definition they are going to use, because that's ultimately where the rubber meets the road, is what's going to go on your 1040. But the neat thing about it is that if you're a single filer, you can qualify for this additional $6,000 exemption as long as your modified adjusted gross income is less than $75,000. Well, that doesn't mean that if your modified adjusted gross income is more than $75K that you don't get it. It begins to phase out at $75K, and it doesn't fully phase out, I believe, until around $150K. So if you're in, this, single file range where your modified adjusted gross income is, is going to be, let's say $90,000, $95,000, you are likely still going to get some of this benefit. So that's a great thing. For couples, the phase out begins at $150 and it's fully phased out at $250K. So I believe that there are a lot of people who are going to have tax planning opportunities, and you need to evaluate where you are falling. One of the things that I would point out, my understanding, so one of the definitions of modified adjusted gross income is you add back in certain things like muni bond interest and taxable Social Security. That doesn't appear to be the definition that they are using for this specific provision in the bill. So I do think that there are going to be a lot of households that have an opportunity here to either pay maybe a lower tax bill or potentially leverage this new enhanced personal exemption for the next couple of years to do some proactive tax moves. And I think that's probably, at least what I'm seeing so far from a financial planning standpoint, probably the meat and potatoes for anyone as far as changes to their current tax situation. It may open up opportunities. And I say that because this is temporary. So this isn't going to be the new normal. This is going to be on a clock where it's set to expire in 2028. So we have a small window of time where we may have these tax planning opportunities to be proactive. Let's see what else we got here. So for anyone that's watching this that is just abundantly wealthy, congratulations. The new estate tax exemption is going to bump up to $15 million per individual. So all that means is that your lifetime gift exemption or your estate tax exemption is now going to be $15 million. So for a couple, if you plan, we could exclude up to $30 million of assets from federal estate tax. I have maintained for a long time that if you're paying federal estate taxes, it's because you didn't plan, because there's so many neat planning tools that can help you avoid those. But I don't think that that's going to affect the lion's share of people, looking at the tax benefits. But just in case we have a DECA millionaire on hand, congratulations to you. Those exemptions have been made permanent, at least permanent in the sense that we understand that Congress can vote to change it, but it reduces any uncertainty about those. Anyone planning to buy a house, there's the permanent extension of the reduction on the residential mortgage, which interest can be deducted. So a lot of people talk about interest on home purchases being deducted. It is an itemized expense. It is not something that everyone just gets a deduction. You have to be able to itemize to claim the deduction, and the way that you itemize is your itemized deductions are actually greater than your standard deduction. And as I just told you, everyone is getting a little bit of a bump in their enhanced standard deduction already. Plus, if you're over 65, you have the additional standard deductions that you get for being over 65. So in my view, it gets incredibly difficult unless you're a certain type of home buyer to be able to deduct this interest. But it is going to be that if your home is, as long as your home is, or the purchase of the home is less than $750,000, the interest would technically still qualify for an interest or to be an itemized deduction. So that's a $750,000 mortgage limit. Again, the code prior to 2017's Tax Cuts and Jobs Act, we had this line item in there that were miscellaneous itemized deductions. Or those have been eliminated permanently, which I think is probably a good thing, because it just added complexity. It was something that a lot of people didn't understand. So I'm not upset with that. But just in case you were thinking that those might be coming back, they've been eliminated again permanently. Another big provision of this bill, and this was really a point of contention, at least in the House of Representatives. There were several reps from some higher income tax states that fought tooth and nail against the SALT cap. So the SALT cap, SALT stands for state and local taxes. And before the Tax Cuts and Jobs Act, you were able to deduct basically an unlimited amount of state and local taxes. So property taxes, state income taxes, local municipality taxes, if you paid those, you were able to deduct an unlimited amount of those as part of your itemized deduction calculation. Well, there were people that argued that really high income tax states were being subsidized by the federal government, because if you lived in California, they pay a pretty high income tax. Well, if they were able to deduct their taxes to California paid to California against what they would owe federally, there were a lot of people that felt that that was subsidizing these higher income tax states. Okay, it's a political argument, but the math was debated, and essentially the SALT cap came to fruition during the Tax Cuts and Jobs Act. But the problem was the cap was set to $10,000, and the unintentional side effect of that was that a lot of people who earned high incomes and had nice homes in other states ended up getting hit by the cap of $10,000, because $10,000, yes, it's not a small chunk of money, but when you start thinking about what someone who's a high earner may pay in state income taxes and their property taxes, that actually impacted a lot of people. So the jury was always kind of mixed. It was always kind of a mixed message here, at least from my seat on the SALT cap, because we saw people benefit from it, and we definitely saw people that were impaired by it, where they ended up actually having to pay a little bit more in taxes maybe than they would have under the old code. Well, they debated this, and the reps in the higher income tax states won, at least temporarily, right? So I think that's a key theme that goes through this entire bill. There are a lot of provisions in here that are temporary, and this is one of them where they increase that from $10,000 up to $40,000 per return. And so this is going to be effective from 2025 through 2029. But if you've been getting capped by the SALT cap, you've got a temporary room in here where you're going to have a much higher cap of up to $40,000. So again, I believe this presents you an opportunity for tax planning where you may be able to have higher deductions or itemized deductions in these years, which may reduce your tax bill. What can you do with that added room? It's going to be temporary, but I think that it could definitely benefit some higher income households that have been getting hit by the SALT cap. There we go. Got it out. All right, let's see. This is interesting because for people who are charitable, one of the things that happened is they definitely during COVID, they created this provision for, typically charitable deductions. For you to get a deduction for your charitable giving, it has to be itemized. Again, as a quick review, to itemize the sum of your itemized expenses like state and local taxes, mortgage interest, charitable giving, the sum of those deductions combined must be higher than what you would receive as a standard filer. And the enhanced standard deductions eliminated the ability for a lot of people to itemize. So, one of the things that happened during COVID was they went back in and they created this small little line item for charitable deductions that you could take a deduction in addition to your standard deduction. It wasn't very high, but it was meaningful, and especially at a time where a lot of nonprofits where their funding was drying up because of COVID. So, what this big beautiful bill did was it actually starting in 2026. For single filers, you can deduct $1,000 of charitable gifts. If you're married, you can deduct $2,000 in addition to the standard deduction. So if you don't itemize or unable to itemize, you can still have a charitable deduction of up to $1,000 for a single file or $2,000 for a married filing joint couple. Now, the interesting part of this is that if you have been itemizing based on your charitable giving because you are very charitable, they now have a provision in the bill where your charitable donations have to exceed 0.5% of your AGI. So there's a little bit of that first bit of giving you get that's less than 0.5%. Would not be counted. Anything over 0.5% of your AGI now is counted as a charitable deduction. And it's a really interesting thing. But what it basically, at least the way my eyes are seeing this is that for people who are highly charitable, most of your charitable gifts are still going to be counted towards your itemized deductions. But for people who are giving a little bit, it may make sense to go ahead and take the just standard $1,000 or $2,000 deduction versus worrying about how to do this on an itemized basis. Now, the big things that were added that Trump debated and campaigned on effectively were the no tax on tips, no tax on overtime. And, basically these are just temporary provisions in the bill. Everything seems to be looking to be 2025 through 2028. The temporary exclusion of income tax on overtime and tips looks to be capped at $25,000. And they're going to have modified adjusted gross income phase outs as well. The phase out seems to start pretty high. So I'm thinking that a lot of people in the service industry, or that receive a lot of their, a good portion of their income through gratuities or through, overtime, they may be able to exclude a good chunk of this because the phase outs seem to be pretty high. It starts at $150,000 for single file, $300,000 for married filing joint. And I mean, those are pretty generous numbers. So I think that that's going to be, stimulative for these households. But again, remember, this is temporary. These were not made permanent provisions of the bill. So I would highly recommend everyone that's looking at anything, when you start looking at this from a tax perspective, I also want to encourage you to look at it from a planning perspective and say, hey, I've got, 3 years of this temporary benefit. How can I maximize this, or maximize this for the next couple of years? Is that the ability to, juice your savings or invest more, save more? Is the ability to, have some tax strategies where you get a little aggressive on your tax planning for the next couple of years? That is my personal opinion on what you should do, because obviously so much of this is just temporary. Here's another temporary. There's a deduction of $10,000 of car loan interest. Don't tell Dave Ramsey, he won't like it, but it does appear that there is going to be an incentive of this interest being able to be deducted. It does look like the provision here is that the car needs to have its final assembly done in the United States, and the loan needs to be taken out no earlier than 2025. So if you are planning to finance a vehicle starting this year or possibly through 2028, the interest can be deductible, and up to $10,000 of the interest can be deductible. So it does look like there's also phase outs on this as well. It says here that for single filers, the deduction begins at $100,000 of modified adjusted gross income. For married filing jointly, it begins at $200,000, and these both phase out over a $50,000 spread. So $100,000 to $150,000 for single, $200,000 to $250,000 modified adjusted gross for married filing joint. But if those figures don't impact you and you're thinking about financing a vehicle, it does appear that this is an additional deduction. So that is a little bit of an incentive. If you're planning to finance a vehicle, it may make it more affordable, or at least give you a little bit of a tax break. So those are, I mean, we've gone through a lot. We've been doing this for about 30 minutes. I know for a fact that there is a delay on the chat, but if you got any questions, feel free to throw one in there as I try to wrap up here. And if I can answer it, I totally will. But those are some of the biggest changes. Again, I think for me, when I looked at this, and I have to be honest, from a tax perspective, I really felt like this was kind of like a big nothing burger, a lot of talk. Yes, we got the extension of the rates, so that's a cool thing. I like the opportunity that these lower marginal rates still give us. There's still a lot of deficit spending in DC where, if we don't fix some of the problems we've got with the deficit and some of the entitlement spending, we're going to have revenue issues. And that's the debate, right? The debate is, how do we fund these programs? Are we going to be able to provide more economic growth and grow our way out, or growth can help mitigate some of the deficit impact? That remains to be seen. But I don't think there were any major changes where, we've got a 4-alarm, a 5-alarm fire, whatever it would be, that we've got to address immediately. What I would say is that there are, I think, a lot of really interesting planning opportunities that could take place just because of the enhanced deductions that we're going to see, the personal exemptions that we're going to see for people over age 65. If you're on an ACA plan and you're now able to actually have an HSA where you wouldn't qualify before, I think HSA accounts are fantastic. It's a great way to save, and they have tremendous long-term tax benefits. So those are my main takeaways. Anyone that's being impacted through the new provisions as it relates to, taxes on overtime or taxes on your tips, those are all temporary. Just like the enhanced personal exemption for people over 65 at $6,000 per person. That also is temporary. So it does give us this little window of time where we have probably some neat planning opportunities to do. So my big takeaways, and my takeaways that I would tell each of you, that watch this video is take this opportunity to review your 2024 returns and start using the back half of this year to look at what comes available, what's going to be active for 2025, and how might you be affected. If you're going to have a reduction in your overall tax liability, that may be it. That may be perfect for you, and you're just happy with that. If you're going to have a reduction in your tax liability because of some of these factors working together, and that gives you room to do some proactive tax planning, I highly encourage you to look at what is available to you and what you can do to take advantage of some of the provisions in this bill while we have it. So that is my takeaway on it. I don't have anything more than that based on that. There's definitely a lot of stuff in here that's political in nature as far as the spending, and quite frankly, that's just outside the scope of what we wanted to cover today. So thank you guys for hopping on and spending some time on Friday with me. I hope you have a wonderful weekend, and feel free to send me an email or shoot me a note if you got questions. We'll get this video tuned up and it'll be available for anybody who missed it. Thanks again, and we'll talk to you soon.